Hey, good evening, everyone. Tonight, Glenn August joins us for our Sunday night speaker series. Glenn is the founder and CEO of Oak Hill Advisors and is a dear friend of the Fifth Avenue Synagogue for many years. He and his family have joined us for the high holidays recently. It was wonderful to see his son in shul just a couple of weeks ago. He's a wonderful young man and you should have a lot of joy and nachas from him and all the entire family.
Amen.
To formally introduce Glenn, it will be Fifth Avenue Synagogue Vice President Mitch Davidson. Mitch really needs no introduction as he has served in a leadership role at the synagogue for many years. He cares deeply about our community, is always looking to elevate the shul and to make it a more caring place. In his personal life, Mitch is an individual who looks to do the right thing, tries to live life with integrity, and works very hard in instilling Jewish values and commitment to the Torah within his family and his children. And this commitment to this ideal is truly admirable. And he also tries to live life in a positive, optimistic fashion, despite the obvious challenges of being a Jet fan. He still has somehow manages to triumph over the disappointment and view life in a positive way. Without the further ado, we give the mic to Mitch to introduce this evening's program. President Jacob Gold will moderate the discussion afterwards.
Thank you, Rabbi, for the kind introduction. This morning actually was very painful from a Jets fan's perspective, but there was a breakfast with football this morning because they were in London today. But as you mentioned, it's a great privilege to be able to introduce my friend Glenn August. Glenn is founder and chief executive officer of Oak Hill Advisors, and as you mentioned, a longtime member and friend of Fifth Avenue Synagogue. Oak Hill is a leading alternative investment firm with approximately $52 billion under management across performing and distressed credit related investments in North America, Europe, and around the world. Glenn has overall management responsibility for the firm and serves as global head of distressed investment activities. He's played a leadership role in numerous restructurings, and since 1987 has served on more than 16 corporate boards. He currently serves on the board of directors of 5 Churchill Special Purpose Acquisition Companies, or SPACs, and also on the board of Multiplan Inc. In addition to his business leadership, Glenn serves on the board of trustees of the Horace Mann School, the Mount Sinai Medical Center, and on the board of directors of the Partnership for New York City and the 92nd Street Y. He earned an MBA from Harvard Business School, where he was a Baker Scholar, and a BS from Cornell University. Well, that was Glenn's business bio, but I have the great honor of knowing Glenn and his family personally for many years. And I can tell you that their personal attributes and character significantly exceed Glenn's very impressive business accomplishments. Together with his wife, Debbie, Glenn has created a beautiful family dedicated to Yiddishkeit and love of Israel, and they have passed this love and commitment on to their sons, Max and Jack, and their daughters, Allie and Sammy. They're extremely generous with their time and their philanthropy. Glenn and Debbie are warm, inviting, and inclusive, and regularly open their home to guests in the most elegant and welcoming way. My wife Nina and I are very blessed to have them as friends. Glenn, thank you for taking time out of your busy schedule to be with us in the Fifth Avenue Synagogue community tonight.
Thank you so much for those very, very kind words. And I can only tell you that it's not easy being a Giants fan either.
Well, they just scored a touchdown, but they're still going to lose.
Well, they've got some ways to go.
That's right. So Glenn, a lot of people on this Zoom don't know you. Could you maybe just start with your background, where you're from, your family background, who you are, if you don't mind, please? Thank you.
Who am I? Jean Valjean. So very simple, short story. Grew up in Long Island, and I describe it as very much a kind of stereotypical suburban background, upper middle class, kind of a cross between the Brady Bunch, the Wonder Years, and the Goldbergs. Went to public school, ended up going to Cornell, thought I'd maybe become a lawyer, because as I joke around from time to time, If you were Jewish from Long Island, you're either going to be a doctor or a lawyer. I didn't want to be a doctor. Sometimes I throw in the joke that if you're not that smart, you become an accountant. But that sometimes seems a little offensive, so I won't say that, although I just did. Although I've now come to respect many accountants. I ended up at Cornell, and as I said, I thought I'd become a lawyer, but very early on, I decided I wanted to do business, and I thought that it would be a really cool thing to maybe get a JD and MBA. I thought that it would be really cool to try and get a bachelor's degree and an MBA in 4 years instead of 6 years, because I had some extra credits when I was in high school. And I ended up getting into Cornell Business School when I was 20 years old, and spent my 3rd year at Cornell Business School. And then when I was there, I said, boy, it'd be kind of cool to go to Harvard. So I applied to Harvard Business School, my 3rd year of college, my first year of business school, and I got in, which was really super exciting. The only thing is they said that I had to go work for 2 years before I could come. And so in March of 1982, I started looking for a job and was really incredibly fortunate that 2 weeks later, I had a job offer to go to Morgan Stanley as an analyst in the M&A department. I didn't even know what investment banking was, but one of my close friends had gotten a job there. And I went to Morgan Stanley out of college. The short story, and we can pause, is I spent 3 years at Morgan Stanley, as it turns out, had an unbelievable experience. And to this day, when I talk about my history, I end up telling more Morgan Stanley stories than almost any other stories. But I went off to Harvard Business School in 85, came out in 87, and was really lucky to be asked to join a new partnership called Acadia Partners that was backed by the Bass Group. And I was invited at 26 years old to become a partner, which was exciting. We had $1.75 billion of capital, and 34 years later, through some evolution of the firm, I'm still there, and it's been just an incredibly awesome experience, and I feel incredibly grateful for having that.
So Glenn, you were going to go to law school and you decided to go into business. So tell us about what motivated you to go into business. Is a mentor, or what happened?
No, it wasn't really a mentor. And actually, I think that the decision to not become a lawyer, and I'm sure there's many lawyers on the phone, and you'll forgive the phrase, some of my best friends are lawyers. But I remember one of the first assignments I had at Morgan Stanley. I was asked to work on a shareholder defense of a very famous company named Key Pharmaceuticals, which was founded by Phil Frost and Mike Jaharis, and they became super successful and generous. And I remember preparing for that meeting. And when we got to the big day of that meeting with the two principals there, we had the head of the Morgan Stanley team, and we had the head of the Skadden Arps team, a guy named Peter Atkins, who became managing partner, super famous lawyer. And the Skadden Arps team had put together a 50-page document ripping apart the articles of incorporation to figure out different shareholder defenses. And I had worked on the valuation of the company. And I looked across the people who had been up all night preparing the 50-page document, and I looked at what I was doing, and literally that day, I decided I was never going to go to law school. And again, we use obviously many lawyers, and I have enormous respect for all the lawyers that we use, but it just wasn't for me. And so the business world, M&A, what I had learned at Morgan Stanley, the markets, the fact that markets change every day, was just fascinating to me from the beginning.
Okay, great. So tell me how you morphed. You're more on the credit debt restructuring side, right? So first of all, maybe explain that to those on the call that might not understand that, and kind of tell us how you got into that, that part of it. What motivated you to go there?
So it really, like many things in life, just in some cases happens. In some cases, you put yourself, or lucky enough to put yourself in a position where it happens. For me, the fund I joined in 1987, this fund, Acadia Partners, was focused on two businesses, private equity and credit. And I joined to be a private equity investor. I had done M&A for a few years. I thought buying companies would be interesting. And I joined in August of 87. And for those that will remember, in October 87, the stock market crashed. And I thought there was incredible value in the public markets. And ultimately, I was given at a very young age a good chunk of capital to manage doing risk arbitrage on M&A deals. And a couple of years later, when Drexel failed in 1990, the managing partner asked me if I wanted to take over the credit business. And I thought, I had some pause, truth be told, but I knew that it was an incredible opportunity. And so I took over the business. I was running about 400 million of the 1,750 million. And for those that will remember, or those that don't know, the early 90s was an incredible period for distressed. And within the next 3 years, I was managing $1 billion of the 1,750 million. And it was an incredible period of investing. And what I would say is, for those that don't know, credit is basically buying the debt portion of a capital structure, typically in buyouts or leverage companies that are below investment grade. And so I like to explain for those that don't know what it is if you think about buying a house and you take out an 80% mortgage and put up 20% of the equity, I basically invest in that 80%. And if you pay a certain price and you have a certain amount of leverage in the corporate world, then you'll become below investment grade, or what used to be called high yield. It's not high yield anymore. Now it's low yield, but it's still below investment grade. And I specialize in investing in the debt of corporate businesses, corporate entities. And when something becomes distressed, when that mortgage, when your house that you bought for, whether it's $500,000 or $5 million, when something goes wrong in the market and the value goes down, the debt will trade down as well. And you could buy that debt sometimes at 30, 40, 50, 60 cents on the dollar. But if you buy into the debt of a good company and you ultimately restructure that into the equity, you can actually make 100 cents or more as you convert the debt to equity. So my firm specializes in credit, although I will say that very early on, I think because of the private equity experience, public equity experience, my view was that the way I wanted to approach debt investing was not buying debt, it was buying companies. And so I often said early on in my career, and to this day, we buy companies, not securities. So we look at a company as if we're going to own the company. And even if we don't, I want to do all the analysis like I was buying the equity. So it's today, the credit markets that I focus on, probably a $5 trillion market. And as was mentioned, I run over $50 billion today. And the opportunity from an investment standpoint is to essentially look across the risk spectrum of credit risk, look across the risk spectrum of liquidity risk. And there's the opportunity to earn, whether it's 5%, 10%, 15%, 20% or more, depending on the risk profile that you take.
Is there a sector that you like, or when you look at the credit markets, or tell us how you go about, finding the right opportunities?
I'd say that it's not. So I'd say in credit, where it's different from equity, is that if you buy a bond, if you lend someone money, you lend them $100 million, they owe you $100 million. If the company performs phenomenally well, they still owe you $100 million. So the equity can go from 100 million to 10 billion, they still owe you 100 million bucks. If you make a mistake, that 100 million can go to zero. And so credit investing is really about earning a small amount of return or modest amount of return with some limited upside, but you have the downside risk you're taking. So the key in credit investing is not to make many mistakes, because you don't get paid enough, other than when you do distressed investing or other segments of credit where there's some higher returns, but you don't get paid enough to take a ton of risk. And so it's all about making very few mistakes, and when you make mistakes, having them be not so costly. And that's a mentality that I think for the best credit investors, understanding quote unquote downside protection, that's really critical. But on the other hand, in distressed investing, when you buy debt at 50 cents, there are many investments. We've invested $18 billion in distressed over the last 3 decades. We made 30% returns on that because we bought at 50 and we sold at 80. We bought at 50 and we sold at 150. So it really varies. It really, for me, investing is all about, whether you're in equity, whether you're in debt, is understanding what is the risk adjusted return and understanding what risk you're taking for what return.
So on the credit side, do you sometimes, let's say the company turns around, so you're doing a turnaround, do you flip the credit or they actually pay you back? In other words, the credit value goes up if the company does better, of course.
Sure.
Right?
So it obviously depends. There are many situations where we'd buy into a company's debt at, again, 20, 30, 40, 50, 60 cents on the dollar. The debt came due. We went into bankruptcy. We managed through the process. We converted our debt into equity. We took the company public and we got more than 100% recovery.
Got it.
So it really varies by the investment.
But like you said, in general, credit, your downside on the equity, your downside could be zero. On the credit,
You can be zero, but you have bigger upside. So the distribution of outcomes in equity is greater. The distribution of outcomes in debt is capped upside, unless it goes bankrupt, maybe you can get more than a required recovery. So the real key is making sure you make very few mistakes.
So in 1990, that was like right after Michael Milken was really in the 80s, the junk bond king. Was that really the big credit market? So
that was the beginning. I mean, Milken created the high yield or junk bond market. And then when Drexel, and certainly there were firms like First Boston, later Credit Suisse, Merrill Lynch, later BAML, and other banks certainly played a role. But when 1990 came with the collapse of Milken, the recession of 1990 and 91, the Gulf War, the real estate crisis, the energy crisis, there was extraordinary opportunity in the distressed market. And if you look at the distressed market over the last 30 years, you had the 91-2 period. You had the 2001, 2003 post 9/11. You had the global financial crisis. You had a mini distress cycle in some sectors like energy in 2015, 16, when energy prices collapsed. Then obviously you had COVID. So it's a cyclical market, but when you're in that moment, you can make 50+% returns. And so distressed investing is, and I run our distressed business. We have a broad-based business. So the outcome in distressed investing is much more similar to equity investing, where you have a lot of optionality to the upside, and you obviously can lose all your money too, just like you can in equities.
So I assume with COVID, it created a ton of distressed opportunities for you and your firm.
You know, I remember sitting in this room in my office at home, actually having COVID. I was an early adopter. I got it in March of 2020 on March 11th. And obviously the market shut down and declined, went down dramatically.
You weren't very sick, were you? You didn't have.
Pardon me?
You weren't very sick.
Well, I had fever for 16 days, but I worked 14-hour days.
Okay.
And I had investor conference calls with 250, 300 or more people talking about the markets, and we were super, super active. And so, like any challenging market, the real key is deciding, how do you want to act? What do you want to do? Do you want to be neutral? Do you want to, again, simple buy, sell, or hold, if you will? And our view as a firm, and my personal view, was that COVID was not going to last forever, and that the downturn in the markets, where really good companies that had COVID impact were down 30%, that if you believe that we were going to ultimately exit COVID, you could make a lot of money. And it wasn't that dissimilar, although there's lots of differences between the 2008 and 2008-9 cycle of distress post-global financial crisis. But some of the best opportunities of our history as an investor was during the most difficult and challenging times in the market. And what I would offer up is the philosophy that we've employed for years, going back 30 years, is to buy good companies. And if you buy good businesses, even when they're marked down, then if you believe they're going to exist whenever that storm comes. I remember sitting in a conference room with my partners back in 2008, and it was a big punch in the stomach for sure. But I said to my partners, who were mostly, totally white-faced, pale as ghosts, and I said, it's not going to rain forever. And certainly the speed this time with the actions by the Fed, by the government to stimulate the economy, which were extraordinary and they deserve enormous credit for, made this bounce happen so much more quickly. But we leaned in and bought made billions of dollars of investments in the first 1, 2, 3 months that are up 50+%.
Great.
And not one, I don't want to kind of hurry here, okay, but not one investment went down. Not one.
Baruch Hashem. That's great.
Baruch Hashem is right. So again, forgive me, but
So I saw
not just about.
Yeah, I saw there was a Bloomberg interview. So you looked at if you're okay talking Equinox and Carnival. Can you talk about some of the?
Yeah, look, Carnival Cruise is a great example. So Carnival Cruise at pre-COVID was valued as a company at $50 billion. And whether one would believe it was worth 40 or 55, it was worth in the marketplace $50 billion. And Carnival obviously was the poster child of a company that needed that COVID shut down.
Sure.
And despite business school and a lot of other education over the years through investing, no one budgets a company to have a zero revenue. So we looked at Carnival and we said, okay, Carnival owned ships that had a cost of $25 billion, round numbers. And they wanted to borrow $7 billion for debt at the valuation of $7 billion for the ships.
Wow, so dollar for dollar.
So $7 billion of collateral of debt, against $25 billion in a company pre-COVID that was $50 billion.
So you're getting a 50% discount to start.
So you're getting an 80% discount from the 80+% discount, 50 to 7, okay? And they offered us 11.5% coupon with a discount with call protection. Those bonds are getting taken out now at 115.
Wow.
So, and we bought into a company called Sabre, which is a big global air reservation system that the stock had been trading at 25. It went down to 3 and change. We bought into the stock at 5. We bought debt and converts. The converts ended up going the stock went from 5 to 15. It's at 12-ish today. The debt went up, the convertible bonds went up 80 points. And so those types of opportunities, when there's crisis, a lot of people panic. And there's certainly good reason to be concerned. And, I was asking that Bloomberg interview, what happens if COVID didn't go away? And it's not away yet. And I know there's a lot of loss from COVID. And I feel deeply for that. In fact, I on Friday, I lost someone in my office, his husband, who just passed away from COVID. So this is real. And I caveated or prefaced every call that notwithstanding the fact that this is the most exciting investment period in my career, or one of them for sure, that there's a lot of loss out there. And so I'm respectful of that for sure. But again, when things get challenged, when markets go down, in some cases rationally, in some cases not as rationally, if you buy really good companies and you have the wherewithal to wait it out, history would suggest you can do pretty well if you pick the right companies and the right security at the right price.
So what about the hotel industry? Did you do anything with that?
So we did. We've done some financing in hotels. That bounce happened very, very quickly. There's recently a deal we did in the New York area with some transitional finance that was coming due, and we structured, we think, a really exciting piece of paper. We did some investing in hotels, but not so much.
Okay, but I know you, or I think I know that you've getting more into real estate, or you hired some real estate people. Can you talk about that? Is that commercial?
Look, I think if you look at what happened post-COVID, you essentially had this panic month from the middle of March, it bottomed March 23rd, and arguably by May, with Fed actions, with stimulus plans from the government, you had a massive, massive rebound. And that rebound continued throughout the balance of 2020 and into 2021. There are, however, some sectors like real estate that are still dislocated. And obviously New York hotels, tourist hotels across the country and across the world have had challenges. Office space with the hybrid models of return to office and work from home have been challenged. And so just like I talk about distress and dislocation in corporate credit, in real estate credit, we believed, and we believe today, there's actually a lot of really exciting opportunity. And while it may not be quite the wholesale level of Carnival Cruise buying $7 billion of ships at $25 billion of value in a $50 billion company to make double-digit returns, we think there's some pretty exciting opportunities in real estate.
And you think more on the commercial side, I would assume, because offices are
I think that there's certainly dislocation in office, and there's a whole host of issues going on in the office space. But I think leisure, certainly we're spending a lot of time on the hotel space today with hotels that we're in process of getting built and really have at this point are substantially below budget and have debt coming due. I think there's some interesting multifamily opportunities where there was projects in action that in development that ran out of money or need additional capital. And so I think there's lots of interesting opportunity. But again, I view my firm as value investors. So Blackstone, Starwood, from the lows, the mortgage REITs that they have more than doubled from the bottom.
Right.
And need to be like anything else, super, super selective.
What about in the retail space? Have you looked at that?
So we have had a view that retail is very challenging generally for the last decade. And it's funny because one of my first jobs is working at the Gap. And now one of my closest friends owns the mall where that Gap owned it probably then too, but where that Gap was. The problem with retail is the secular set of issues on retail, and obviously accelerated through COVID in terms of online shopping, really dramatically affects bricks and mortar retail. And it doesn't mean that there can't be some amazing concepts that break through, but all you need to do is walk down Madison Avenue and you see so many storefronts just empty. And obviously that's a particular set of issues, but it goes across the board. And again, there's some really good companies. There's some great stories where you can make more money in the equity, but as a debt investor, we've generally steered away from retail for many years.
So talk about Lucid Motors, which is a really exciting company. I wouldn't think that's a debt deal. So tell me how Glenn August got on the
Sure.
board.
It's a great question. So the short story there is, as Mitch mentioned, I've been involved in the SPAC business with an old friend and partner of mine, Michael Klein, who ran Citibank's investment banking business and really was one of the pioneers in this wave of the SPAC business. Michael created this entity called Churchill, where he's done 7 or 8 different SPACs, and invited me to join the board of the Churchill entities as a partner and as an investor in the sponsor capital. And I thought that was a very exciting opportunity, and thought that with our knowledge of the leverage finance markets, we could potentially identify companies that would fit a SPAC profile. Anyway, fast forward, one of the opportunities that Michael identified was in this company called Lucid Motors. It was not a classic leverage story at all. In fact, it was a growth equity story and one of the leading EV companies that is coming to market right now. Fast forward, Michael and Churchill 4, which was the SPAC that I was involved in, did a de-SPAC transaction, took Lucid public, and I thought it was such an exciting opportunity. I wanted to join the board and be part of it.
So that's through your fund, or that's on your own?
That's Oak Hill Advisors.
Okay, and how are they different than Tesla? They're higher, they're nicer.
So I have to be a little sensitive because I'm on the board, but what is very public is the CEO of Lucid was at Tesla and helped design the Model S. They just came out a couple of weeks ago and announced that their vehicle gets 520 miles of range, which is 100 miles or so better than any EV out there. And they're coming to market. They're coming to market with a higher end vehicle that is getting produced. They had a big launch in Arizona last week, and I think you'll hear a lot more about this to come.
Okay, and then that's for those that aren't as familiar with SPACs. So SPACs have been around for a long time, but they came more in vogue the last couple of years, would you say?
Yeah, I think that there was the SPAC structure, especially in a low interest rate environment, is very attractive because investors basically get the opportunity to approve a deal. They put up $10 a share, and they can either approve a deal or they can get their $10 back. Plus, they get a warrant that has value if the company that gets acquired does well. And so in a very low interest rate environment like we're in, it's essentially an option that has total downside protection or near total downside protection with the $10 that is in the trust waiting to do a deal. And if you pick a good company, then the opportunity is for that stock to go up materially. Lucid today is trading over $20 a share. And so for those investors that bought it at 10, they've made more than a double over the period.
So the SPAC, in other words, could be credit, could be debt, could be equity. You can use a SPAC at any structure.
Well, yeah, I wouldn't describe it that way, Jacob. But what I would say is the SPAC is essentially using its equity to take a company public using its shares, and it merges in, and the successor company is now partially owned by that SPAC and whoever else owned the equity before. It's don't think credit, just think public equity. It's just a way for a company to go public.
To go public sooner than it usually would.
Well, not necessarily sooner. It could potentially go public in the traditional IPO markets, but there may be reasons why companies may choose to go the SPAC route. You get the opportunity to give projections. It can go more quickly. You can guarantee and negotiate that valuation with the SPAC sponsor, and ultimately they raise capital in what's called a PIPE, which is private investment public equity. And so it's basically a greater certainty that it gives a seller to go public.
Again, you serve currently on 3 SPAC boards?
Yes, it was 5 as the time when Mitch read the gave the bio, but since that date, I now am on 3 because one company de-SPAC'd with a company called Skillsoft. I did not join that board, and the other one was Lucid, and I joined that board. So it's 3 plus Lucid, and Multiplan was also a SPAC transaction.
And does your firm usually have a controlling interest on the board, or not necessarily?
No. So let's separate SPACs, because SPACs is really a separate activity. So when you look at our distressed business, I would say that 1/3 of the investments in our distressed investing business are more control oriented, where we either have a board member or control the board. Another 1/3 plus is influence, where we have active dialogue with management. And then another 1/3 plus or minus is trading.
Okay, I was also curious. I mean, things evolve, quickly. So there are you like maintain relationships with these companies, and sort of at the right time you come in, or tell us more about the process.
So again, we manage over $50 billion and we invest in hundreds of companies. And our investors are giving us money to make 5%, 10%, 15%, again, depending on the risk and liquidity. And our job, I have 375 people. Our job is to scour the markets every day, much like any other investment manager, to look for opportunities in the primary markets, which is new issues, where private direct investing and private credit is a very big opportunity in our view, or to buy in the secondary market. So every day, last week we did $1.5 billion of trading just in our leveraged loan business.
Wow.
So it's a lot of activity, and so we have dialogues with hundreds of companies trying to find good value and good businesses with good management teams every day.
So talk about domestic versus international. Or 80% of your companies are domestic, or?
Yeah, so I would say in our performing business, not distressed, it's probably 90+%. In our distressed business, it's been about 70-30. We have had an office in London since '05. We were one of the original distressed investors back in the early 90s that I was deeply involved in. I actually worked at Morgan Stanley in London for a year back in the early 80s. And so the European leveraged finance market is one that we're definitely a big part of.
And so how has America picked up before Europe, or like globally, how are we doing America versus Europe?
So the short answer is the US markets, US companies have generally been a bit ahead of the European companies. The US equity markets have meaningfully outperformed the European equity markets. And I do think that having the Fed and the centralized stimulus basically, and obviously a more unified approach, even though there's lots of division on the vaccine, I think all those things were very, very helpful. But even pre-COVID, the US markets over the last couple of years have outperformed the European markets. There's lots of structural set of issues in Europe.
So what's your perspective? A lot of people talking about inflation, because inflation really hasn't been a discussion for at least a decade, if not longer. So what's your perspective on inflation? Does it keep you up at night, or?
Well, I try to sleep well, but look, I think inflation is a legitimate concern. And there's this obviously giant debate going on right now of, is inflation transitory? I.e., you may have some short period of time where commodities are out of whack, supply chains are out of whack, labor costs going up, just deal with some shortages. And there's certainly a view that obviously have left, not obviously, but for those that follow the markets, the 10-year treasury today is 150 or so. And that would suggest that there's not a ton of fear. I might look at my screen. It's 161. Forgive me. It sold off last week. But 161 is still quite low by historical standards. In COVID, the 10-year treasury was below 1%. And I spoke on many panels earlier in the year when equity markets had gone up so much and treasuries were still at 1 to 1.25. I was like, this makes no sense. We're ultimately going to have some inflation with all the stimulus. And sure enough, the treasury market went up to 180 on the 10-year. But then as Delta came back and the Fed seemed pretty calm about it, treasury rates went back down to 1.25 or so. And now in the last few weeks, as there's much more signs of potential inflation risk, gas prices, natural gas prices, labor costs, labor shortages, the fact that we have more jobs available than there are unemployed people today suggests that labor inflation might be real, and labor costs represent 60% plus or minus of all costs. And so my personal view is that I think inflation has some risk to it. And my personal view is it is more likely that rates go higher, then stabilize here. But you can't underestimate the amount of productivity from technology and the lowering of costs that exist. And so it's definitely a tug of war. My job is less about betting on rates, and it's much more about betting on companies, and certainly running scenarios under high cost environments and what happens to margins under low cost environments. And again, when you're investing in the debt, you have some equity market cushion to basically protect you.
So what about China? Do you invest in China? Does what's going on in China concern you, or what's your perspective?
So the answer is we don't invest in China.
Okay.
We certainly thought about it from time to time, and I do fundamentally believe that as an equity investor, there is going to continue to be growth in China GDP. I think there's going to be growth in incomes. And so I think there will be many companies that make a lot of money in China and grow materially. It's not a debt type of investment because, again, the ability to execute on debt protection with a different government regime is very, very difficult. So we have stayed away from debt investing in China, but I certainly am supportive and believe over a medium to longer term that Chinese equity investing on a very selective basis can be very profitable. But the unknown is what the government does. And so you take a company like Ant Financial, you take a look at some of the recent actions by the Chinese government, and it would give many investors a lot of pause. And so it's not what I do. We do have investors from China. We have a good relationship with them. As a political matter, when one asks me about the risks in the world today, I certainly highlight that China, it represents a risk to the US, that perhaps some of the activities with Taiwan and China's desire, which I totally respect, and countries have to act in their own interest. They certainly have an ambition to be they're already one of the most important superpowers in the world, and I think the Chinese government has a desire to be an even bigger influence on the world. And so I think we are in a global competition with China, but and I think there is some potential for destabilization at points in time. But China's economy drives so much of the businesses that we invest in that we need to understand their economy to figure out our global investing strategy. So whether if you own a company in Europe, you own a company in the US that has its supply chain in China or customers in China, then you have to incorporate that into your view.
Okay, I appreciate that. So talk about cryptocurrency. Do you just stay away completely, or what's your?
Yeah, I'm gonna, my son Jack would be, if he's watching, when he watches, will say, Dad, I told you should have focused on this. But the short story is, I have built my career in understanding businesses and management teams and competitive dynamics. I certainly know that many people have made extraordinary fortunes over the last number of years buying into crypto. To me, I look at it as a market with supply and demand, like all markets. And obviously the price going up dramatically and the volatility is just indicative of those technicals. And I had an old friend of mine who would often get interviewed on, he was a floor broker at the New York Stock Exchange, and he would often get interviewed on an afternoon around 3:45. And if the market was up, he would say, well, I guess there were more buyers than sellers today. And it was down, he'd say, I guess there were more sellers than buyers. A guy named Teddy Weisberg, for those that may know him, he's a lovely, lovely, lovely man. And there's obviously more buyers, if you will, for crypto. It's not area I hear all the blockchain analysis and how it can be an important tool. It's just not what I specialize in.
Okay. You'll wait for the credit opportunities
Well, we'll wait for something that I feel comfortable investing in. Again, you have to know what you know what you don't know.
Sure. And to talk about, we both live in New York City. we're investing in the renovation of the synagogue, and you've been very supportive. But talk about, New York City. Were you nervous at a certain time, over COVID?
Sure.
But it's a little more than COVID, but it seems like it's coming back. I'm curious your perspective.
Look, this is not a political discussion. I don't want it to be one. I love the city, except for 1 year in London and 2 years at business school. I've lived in the city since 1982. My wife is from the city. My kids have been raised here, and I love the city. And that all being said, let's leave COVID aside. Let's leave the vacancies on Madison Avenue aside. There's definitely anxiety about public safety. And whatever you read, the stories just seem to be worse every other day. And even if some statistics make it seem better or make it better, there's certainly concern about public safety. I do think that Eric Adams, I am excited about what he says. I am hopeful that what he says is what he does, because I do think that the most important thing about making the city or keeping the city great is public safety. I do think that not just in New York City, there's a whole divide of rich and poor, and equality and income inequality. And I'm certainly understanding of all those issues. But again, I think it starts with public safety. Obviously, there's affordable housing. There's a whole host of set of issues. I think New York's an amazing city, and I don't want to live anywhere else. There's a lot of great cities in the world, but I love being here. And I am hopeful that with a new administration that we can, again, deal with some of the issues that are here. I think that the business community, I'm on the partnership for New York City's board. We were fortunate to have Eric Adams and Kathy Hochul last week. And the message that they were offering up was one of a constructive relationship with business. Business is not the enemy. Business wants to be a partner. And I think that a good set of relationships between business and public governments, local governments, is ultimately going to be super helpful. And we need to be supportive of our police. And there's certainly bad apples and bad policies. I'm not here to judge any of those, but I think it's a great city. I do believe it will be back. I think the tourism will come back, especially if there's public safety. And I love where I am.
Oh, great. Now, you also serve on the board of Mount Sinai Hospital. So tell us a little bit about how long you've been involved. And
Yeah, so, well, I've been involved.
3 kids born there, so.
Well, not more than that, but equal to add, both my wife and I were born there too.
Okay.
So long history with Mount Sinai, and it's certainly, New York is blessed to have some of the best medical institutions in the world, and certainly Mount Sinai is one of them, and they're doing incredible things. And certainly their leadership in COVID, both on take care of people as well as the science, has been extraordinary. And I think if you're fortunate enough to be able to be supportive of a healthcare institution, Sinai is a great one, but there's obviously other great ones in the city. And having that window during COVID made, better informed me. Although obviously there was, you could watch a lot of things on TV and other sources. And it's nice to be part of such an important institution that is, again, part of the fabric of New York. And obviously Mount Sinai, with its primary, or it has obviously many, many different hospitals, but where it's located and serving both the community north of 100th Street and below 100th Street, really is a hospital center for the community. And it's really an honor to be involved. And so I've been on the board now for, I think, a decade or so, and just really proud to be part of it. That's
great you do that. You're also, are you still active in 92nd Street Y, or?
So I am coming up my 20th year in the 92nd Street Y on the board, and I was blessed to have all my kids go through the nursery school, but it is so much more than a nursery school. And being part of what is really a great New York cultural institution has just been a privilege too. And obviously, talk about impact of COVID, both opportunity and challenges. When you close a venue, it's very hard to pay the bills. And fortunately, the team at 92nd Street Y did a great pivot and offered programming online, but it certainly got its own set of financial challenges and opportunities. And it's really, I think, one of those great institutions. There's a lot of great cultural institutions in New York, but having that combination of culture and Judaism, and it being a Jewish institution, and the access it offers to everybody, I just think is fantastic.
Now, I've been to your home. I know Mitch mentioned you open your home. I know Slavi Young Rice. We actually have Chaya Sarah giving a class at Fifth Avenue. But maybe talk a little bit about Hineni and your involvement.
Yeah. So I broaden the question a touch and just say that my family's been on an exciting Jewish journey, and my wife deserves a lot of credit for it. I personally came from conservative, then Reform synagogue, and then got more interested and became probably a bit more in the conservative synagogue after college. But my wife was a long-term member of family of Park Avenue Synagogue, and then she met Esther Rebbetzin Young Rice and her daughter Slavi and many members of the wonderful Young Rice family. Long story short, she started to study with the Rebbetzin, and Judaism just became elevated in our home. And so probably now around 25 years ago, we started hosting a young couples class. And we had in our home, which was monthly, Debbie hosted another class and lots of classes. And we had to drop the young couples name, I guess, about 10 years ago, but I'm just kidding. We're still calling ourselves young couples. But our Judaism is important to us, and Hineni and the Rebbetzin, and may her memory be for a blessing. But the Rebbetzins family, our son Max is named Moshe Meshulam in honor of the Rebbetzins' husband, the rabbi. May his memory also be for a blessing. And I think Hineni's played an important part in our lives and making our home a Jewish home. And my wife has done an incredible job. And our kids, Judaism is important to them. And my son Max is spending a lot of time on Israeli growth equity, but is also super committed to Israel and to fighting anti-Semitism. And I couldn't be more proud.
That's great. I appreciate that. There was another thing I wanted to mention. You mentioned there are three things in investing. Correct me if I'm wrong: trust, respect, and likeness. Is that?
No, I might frame that slightly differently with most of the same words. So after doing this for 34 years since business school, you get to figure out what's important to you in not just in business but in life. And I think the phrase that you're referring to is my phrase called like, trust, and respect. And I think it actually transcends business, but I think it's actually a pretty important piece of how one thinks about business. And that is that ultimately we're all people. And I'm a big believer that one should be respectful and nice to everybody, because we're all the same. We come in the same way, we go out the same way, and some of us are luckier and more blessed than others, but we're all the same is my basic view. And I believe the best relationships in business, and I believe the best relationships in life, are those that are based on liking someone, trusting someone, and respecting someone. And when I think about it in the business context, because we manage money for hundreds of investors, some of the 17 different sovereign wealth funds, a ton of different pension funds, a ton of ultra high net worth families. People who have money or who are charged with managing money, in no order, but let's just start with the order that you would think, they really want to respect who they're investing with. So they've got to believe that whomever they're giving money to is going to do a great job with it, that they've shown a track record, they've got skill sets, they've got whatever it takes to go generate the returns that they're hoping to generate. So respect is clearly fundamental. But the second thing is that they have to trust the person or the institution. Because you may think someone is phenomenally smart, best ever. But if you have to worry that you can't trust them, then you don't want to do business with them, as you shouldn't. Okay, so let's go to the third thing, because the reality is there are a lot of great firms out there. In what I do and whatever everyone else in this phone call today, the Zoom call, there's a very healthy competitive world we live in. And there are a lot of people who do what they do well. And so there's a lot of people that actually you can respect. There's actually there's definitely bad people out there, but there's a lot of people that you can trust. And so therefore, if you think about the third piece, if you're giving someone or institutions giving 100 million, a billion, or 5 billion, and they trust and respect, ultimately they also would like to like the person.
Right.
To feel that there's common ground. And so I believe in business, I believe in life, like trust and respect is really important.
Yeah, no, I'm happy. I agree with you 100%, but a lot of people don't articulate it as clearly as you do. So I thought it was important to hear that. I'm going to invite Ray Babbage and Mitch, because we're coming on the hour, if they have any questions. And while they're coming on, are you affiliated with the Milken Institute?
So I have been supportive of Mike Milken over the years. I hosted a number of, Debbie and I hosted some functions at our home. I attend the Milken conference, and Mike Milken is certainly had some different moments of his life that were more challenging, both professionally and from a health perspective, but he is a visionary and someone that I have a lot of respect for. And certainly his philanthropy has been extraordinary in the think tank elements of what he's doing, as well as his connectivity with the business community, the public health community, education, so on, is just extraordinary.
Great. Mitch, did you want to add something?
No, I just wanted to thank Glenn for the time. And, even though I thought I knew everything there was to know about you and your family and your background, I learned some things tonight too. So I thought it was amazing. And thanks again for doing it and spending your Sunday evening with us.
Well, thank you. It is, I looked at the list of people you had, and I was honored to be added to that list. And the Fifth Avenue Synagogue is just an extraordinary institution. And I thank you and Jacob and the rabbi and the entire community for what you're doing. And it will always be an important place to me and to my family. And Max was bar mitzvah there. And I often, unfortunately, will go there for yard site since I lost both of my parents. And everyone is always just incredibly welcoming. And I do think that the challenge for all of us as Jews is to keep the fire burning, because we're obviously under attack in so many ways. And having young leadership that really wants to make this institution even greater and shine even brighter is so critical for all of us. And so thanks to you, Mitch, and to Jacob and to all on the phone for keeping this incredibly important institution thriving and growing. And God willing, we'll have even greater success in being an even more important and significant institution, not just here in New York, but around the world. So thank you all for that.
And thank you for your support of the renovation. We still have to show you the full plans, but we'll get there. But Rabbi, did you want to add something?
I just want to also conclude by thanking Glenn for thank you so much for your time. Obviously a very successful business person, but somehow you remain humble and committed to the ideals of Judaism, which is an incredible accomplishment, and we commend you for that. May you continue in those ways. And thank you for being a friend in the shul. It's always wonderful to see you, to see your children, to your family. And please God, may we only celebrate happy occasions and good health for many, many years to come.
Thank you, Baruch Hashem. Thank you so much. I really appreciate it.
Thank you again. Thank you for sharing your valuable insights and perspectives tonight, Glenn, and have a great evening. Regards to Debbie.
All right, so long. Thank you.
Thank you. Bye-bye.